Hey everybody, Marty Missouri here, after hours on Tuesday, the 27th of June, 2023. This is your midweek stock market snapshot. I will send it out attached to an email to you clients first thing tomorrow morning. So what we're going to look at in this presentation is the usual. The daily, probably just the daily chart on the S&P 500 and QQQ, the NASDAQ 100 tracking ETF. I want to take a look at investor sentiment again. I want to look at the dollar and then a couple of data points that came out today that got the bulls really excited. And I'm going to try to put that in, at least in what I believe is its proper perspective. Kind of play off of that theme from the 15th, a week ago last Friday, June 15th video that I shot where I said the market was as toppy as it's been since the top and what's happened since then. So here's your chart of the S&P 500. That actually started back here before the market actually topped back in January of 2022. And that video we shot right here, right on that up candle, was the 15th. And sure enough, broke down below the wedge with some momentum. And then today found support right at that 43.25. Makes a lot of sense. If I scrolled this back, you'd see lots of action right on that line. Big up candle today. You know, you could argue that, hey, that we tested that resistance, succeeded, now we're going to go back up and then probably test this high once again. And you know, we absolutely could. And you know, our base case is that odds favor a significant break of that eventually, but it may not be, you know, this week or next. It could be over the course of the next few months if it happens at all. And then ultimately, if we do get recession, which our indicator is still flashing recession in the not too distant future, then we think stocks need to reprice even below last October's low. Now that has to happen. It's just based on the data as we see it right now, and to some degree the longer term technicals in the market as well. All of it subject to change, and of course we're open to all possibilities. With regard to that toppy look, just to kind of remind you on this chart, it was as much about the overbought level right here when we ran that video, right? So that's an RSI, relative strength index, above 70 is technically considered overbought. We haven't had that kind of overboughtness, if you will, since when? November of 2021, just a month or so before the all-time high, which we had right here, right? We also had a sell signal on the moving average convergence divergence, and by the way, we have one right now, which is the white line dropping below the signal line, which is the red line. If you look back here, when we actually rolled over and we got our signals and we were very overbought, the market actually came back and established another all-time high. However, we had waning momentum, right? And it just looked destined to at least give us a correction right here. Well, it gave us a lot more than just a correction. It gave us a bear market, right? And along the way, though, we were pointing to some real pretty bullish setups, at least in the near term, kind of counter trend setups. You can see we got a nice pop there, but ultimately it took the market down over 20%. Now recall back here, we actually set that as our bear market target with the caveat that as long as there's no recession or we're not signaling recession, because we weren't back up in here. But by the time we got there, we had a very bullish commentary right here. That's what these green rectangles are all about, and that's what this is about. But if you'll recall, I had lowered our target actually to about 3,200 at that point because our recession indicator was, as it still is today, flashing red. Okay, so today, again, we've got our bearish rising wedge pattern. We were still breaking down, coming down off of overbought levels. And then looking at the NASDAQ 100 tracking ETF, as we would expect, technically speaking, right, broke out of that rising wedge pattern, exceedingly overbought conditions here, RSI of 80. Haven't seen anything remotely near that except for right before the market peak, right? So very strong sell signal in force right here, coming off of overbought levels. However, big bounce today. We'll see if that gathers some steam going into the end of the week. Recall that when we shot that video on the 15th, sentiment was one of the areas that I talked about as being as toppy as we've seen, or toppier, or as toppy as we've seen since the top. American Association of Individual Investors bullishness was just above 50 that particular week. And last time we had anything above 50 was right before the market peak. And here we are. I'm still going to leave that question mark up there because who knows? We could just break back up to and form a new interim high. But right now, pretty compelling reason to be cautious, at least in the short run, right here. The dollar is really important to look at these days when we look at the character of the trading that we've been seeing. Remember, our equity market conditions index that we score at the end of each month is solidly bearish in terms of overall conditions. But I did say that there's one bullish development that we really should pay attention to, and that was a bearish dollar pattern. We had a bearish rising wedge. We were rolling over on the momentum indicators. And I said that if that plays out, that's bullish for stocks. That could be enough to at least get some short-term positive action. And we've had a really nice rally while the dollar has been rolling over, and I'll show you that here in a second. But then recall, right in here, I was saying, this is beginning, drew a little line there, this is beginning to look potentially bullish. And if we break out of this channel with a little momentum, right, that actually would be bearish for stocks, all else equal. So we have broken out of that. Now we're testing the top end of this channel right here. Still looks on balance pretty bullish to me. Right here we had a bullish divergence relative to what was going on in the price action. Okay, so when we look at the S&P and the dollar without all that noise on the chart, so the top panel here is the S&P 500. Here's the dollar. So here we were rising in May. Now the cap-weighted index was actually up a little bit. It was the equal weight index that saw that 3.5% decline. And remember, you take out literally a handful of stocks and the S&P is flat to down on the year. But nevertheless, I said that amid a real negative overall score for general conditions for stocks, short term, if the dollar rolls over, right, we think that's probably bullish for stocks. So literally right almost to a T. Dollar rolled over, stocks rallied. Okay, now we were talking here about the dollar maybe bottoming and maybe we catch an updraft. Well, that's consistent with when the market rolled over, right? So if we get through June and we go into July and it looks like we have a stronger dollar setup, that's going to be potentially a real headwind. Of course, that remains to be seen, and we'll explore that bridge as we get to it. Okay, so durable goods orders came out today, and they were surprisingly hot. They were better than expected. And man, was there a bull party on Twitter, and we certainly saw it to some extent in the market. Actually, it was bullish. You could argue that it should have been bearish, because if we suddenly start seeing data points that say, the recession odds are diminished dramatically, well, that's going to do nothing with regard to staying the Fed's hands, which this market has really wanted to see, because inflation isn't going to go away without, I think, a markedly slowing economy. But I wanted to point out why it's so important not to get stuck or hung on a bull thesis or a bear thesis, because that's when you can get into trouble. When you look at things like durable goods orders, I saw one permabull tweet that, see, what did we tell you? You don't have recessions when you have durable goods orders doing this. And I beg to differ. So here's durable goods, right? And here's this big May bounce, right? Here's durable goods right before the COVID recession, right? Here's durable goods spiking big time right before the Great Recession of 2008, worst recession since the Great Depression. And here's durable goods orders with a huge spike just months before the tech bubble recession, so to speak. So absolutely unequivocally, on one end, sure, that's a good sign. On the other end, don't go running too fast with it, because it's not unusual to get big spikes. It's somewhat noisy, right before a recession. And then another one that the bulls celebrated was consumer confidence. And again, I get it. I understand it. We're looking at it, and I believe we're looking at it objectively. But we don't want to get out over our skis, so to speak, because of, one good monthly number, right? But there is the Conference Board's consumer survey for May coming out today, and that's a nice, better than expected pop. It's still at a low level overall, right, at 109.5. And do we get pops before recessions? Well, here's one, right? Here's one. Here's a big one, right? And here's a little one, right? Right before, within weeks or months, or virtually coinciding with recession. So again, positive. It may even improve the score of our economic index when we score it this weekend, but we don't want to go running off with just a few data points to go with and take on the kind of exposure that we very much expect to take on when the data tell us that the coast is clear and it makes sense to put on more risk. One other one that I probably should save for the weekend, but it's just so interesting, I thought I would show it. So this gentleman, Nick Gurley, I guess is how you would pronounce that. He is the CEO of Reventure Consulting and Reventure App. It's the #1 real estate channel, so they say, on YouTube, with over 4 million monthly views. And I frankly was surprised to see from Airbnb's numbers the revenue collapse in 10 cities. So percent change in revenue per available listing from May 22 to May 23. In Tennessee, 50-ish% drops. Phoenix, Arizona, Texas, 46%. South Carolina, Florida. Big revenue collapse jibes with what we see is notably above average recession risk going forward. As this relates to the stock market, and why I bring it up is because that first leg of the bear market and that first target that we set was based on where we thought stocks should reprice. It was really technical analysis that gave us that price. But the thinking was this is where they should reprice based on rising inflation, higher interest rates. Stocks valuations should come down in that scenario as interest rates go up, plus cost of capital for corporations and how that could hit earnings. But that would be enough if there's not recession. The recession then does a number on corporate earnings in a big way as people stop spending. And that is something that absolutely is not priced in stocks as we sit here today. And that's where we get concerned about further downside before it's all said and done. Folks, I'll leave it there. Thank you, as always, for watching and listening. Be back with a video at the end of the week and then our economic update. But before then, I'll have a written note for you on Thursday morning. Thanks again. Bye-bye.